If you have a mortgage, a credit card, or a student loan, the interest rate you pay is tied to a global network of financial contracts worth roughly $350 trillion. You might assume those rates are decided by the invisible hand of the free market, but in reality, they were fixed over breakfast by a private group of 16 bankers in London, the rate at which top global banks lent money to each other. Because it was viewed as a mathematically pure baseline, it quickly became the bedrock of international finance. Sovereign nations, multinational corporations, and hundreds of millions of everyday citizens had their borrowing costs dictated entirely by this one daily number. The mechanism to set it ran like clockwork. Every morning at 11 a.m. London time, 16 of the world's most powerful investment banks, heavyweights like Barclays, Deutsche Bank, and Citigroup, submitted an answer to a single question. At what interest rate could your bank borrow cash from another major bank today? The highly structured daily ritual projected a sense of total objective authority. But behind the polished facade of Wall Street and the City of London, that number was completely fabricated. We can see exactly how the official rate was calculated in this breakdown. Thomson Reuters collected the 16 submissions, but they didn't average all of them. To prevent extremes from skewing the data, they would trim the top 4 highest rates and the bottom 4 lowest rates. The middle 8 were then averaged together to create the official LIBOR rate for the day. The math itself is clean. The fatal vulnerability lies in the raw data feeding it. The numbers these banks submitted were not based on real executed transactions. They were entirely self-reported estimates. There were no receipts to prove a bank actually borrowed money at the rate they claimed. There were no audits, and regulators required zero verification. The stability of a multi-trillion-dollar global market was effectively an honor system. We trusted a handful of private traders, sitting quietly at everyday desks in London, New York, and Tokyo, to accurately report their costs. Placing a verification-free honor system directly next to a financial market, where shifting a rate by a fraction of a percent dictates massive personal profits, creates a specific environment. It guarantees its own corruption. By the early 2000s, the original purpose of LIBOR, measuring real interbank borrowing, became secondary. The explosion of complex financial derivatives turned the benchmark into a tool for active trading floors. These desk managers held multi-billion-dollar bets tied directly to tiny daily fluctuations in interest rates. This dial illustrates the financial leverage at play. A shift of just 0.01% in the final daily rate could generate $10 million in profit for a single trader in a matter of seconds. The traders realized very quickly that they didn't need to try and predict which way the market would move. Because their own banks supplied the data that made the market, they could simply call down the hall to the guy typing in the daily LIBOR submission and tell him what number to submit. They coordinated across competing banks through private, around-the-clock chat rooms. They gave themselves names like the Fellowship, the A-Team, and rather accurately, the Cartel. Declassified transcripts later revealed how cheap it was to sway the foundational metric of global finance. Traders would send messages like, "If you keep the rate low today, mate, I'll pay you 50 grand," or offer a bottle of expensive champagne for a favorable tweak on a settlement day. The submitters usually replied with a simple, "Done, skipper." For over a decade, the core operating code of global capitalism was quietly hijacked by an elite club of private traders explicitly to maximize their own quarterly bonuses. While individual greed drove the manipulation for years, September 2008 introduced a far darker motive. When Lehman Brothers collapsed, global interbank lending froze completely. Banks were suddenly terrified that their competitors were secretly insolvent, and they refused to lend out cash at any price. This created a lethal trap for the surviving banks. If they submitted an honest LIBOR estimate reflecting how spike in borrowing costs acts like a flare gun, it signals to global markets that your bank is on the brink of bankruptcy, instantly triggering a fatal run by your depositors. To prevent their own collapse, the top tier of international banks engaged in systematic lowballing. Every morning, they deliberately reported falsely low interest rates to project perfect financial health to investors and credit rating agencies. They didn't do this in a vacuum. Internal memos later proved that senior central bank officials at both the Federal Reserve and the Bank of England knew the published rates were artificially depressed. Regulators watched the banks manipulate the data and actively allowed it to continue. They decided that maintaining the appearance of a functioning financial system was more critical than exposing the truth of its collapse. The wall of secrecy finally broke down when investigative journalists and regulatory whistleblowers started tracking this specific divergence. They noticed that the pricing of credit default swaps, which measure the real-world risk of a bank failing, had violently decoupled from the artificially low LIBOR submissions. The math simply stopped making sense. In 2012, international regulatory agencies launched a massive, coordinated investigation across 3 continents, cracking open servers and seizing decades of chat logs. They uncovered institutionalized fraud spanning virtually every Tier 1 investment bank on Earth. Regulators levied over $10 billion in fines. Several prominent chief executives were forced to resign, and a handful of individual traders faced criminal prosecution. As the data became public, the real victims emerged. Cities, municipal pension funds, public school districts, and sovereign borrowers realized that for years they had been paying artificially inflated interest rates on their public infrastructure debt. By manipulating a few decimal points in London, banks had effectively siphoned taxpayer money out of public budgets and funneled it directly into the bonus pools of Wall Street trading desks. In the wake of the scandal, global financial authorities declared the era of self-reported rates dead. They systematically dismantled LIBOR and replaced it with new benchmarks, primarily the Secured Overnight Financing Rate, or SOFR. Looking at the structural difference, SOFR solves the core vulnerability. Instead of relying on a trader's estimates, it is calculated directly from trillions of dollars of actual, verifiable transactions in the overnight repurchase market. The math is tied to receipts. But while the technical loophole was closed, the underlying reality of the global financial architecture remains intact. A highly concentrated web of private mega-institutions still manages the world's wealth, wielding immense influence over sovereign economic policy through mechanisms entirely shielded from public view. When you examine the mechanics of modern finance, the greatest mystery is never why the market moved. The mystery is who was quietly allowed to set the price.